Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar.
Hey, good day, everyone. Welcome to another podcast, Your Tax-Free Life podcast, which we do and bring to you every single week. Today is episode number 77, and the title for this episode, it's a very critical one because it's something that is happening right now, and it has been happening over the last few weeks, and it is on the importance of protecting your retirement assets in a volatile market. As many of you know, we've had a tremendous amount of market volatility so far in 2019. We are fast approaching, we're actually in June now, so this is the middle of the year, so this is where many of us need to start taking a look at our investments, our portfolio, our retirement assets. If you happen to be in business, you need to start looking very closely at your P&L statements, or your balance sheet, your statements of cash flow, because any changes that you want done, any changes that you want to make, it is time to do it now, because obviously you want to be able to maximize not only what remains of 2019, but you also want to prepare for 2020 and beyond. From an investment, a retirement, from a business and or a tax planning perspective. As many of you know, obviously the last couple of weeks have been very, very critical for the U.S. Stock market. And in lieu of all the market volatility that we've seen over the last few weeks, not only in the U.S. but also around the world, I think it is important to understand risk from an economic perspective, and this is something that I talk about in just about every single seminar or workshop or webinar or podcast that I do on a regular basis. Even today, and this is sad to admit to, even today many of my clients continue to play Russian roulette with their hard-earned dollars in the stock market every single year. And although we have discussions through the process that we conduct here at Cambridge and Gables Tax Planning Group, which is one of doing at least 3 reviews and tax planning reviews every year with our clients, this is a conversation that I have with many of them. Now, obviously, many of my clients have taken up and have taken my advice, and they have started to protect their retirement assets and their investments from stock market volatility. But many others, they keep saying, yes, I need to do something about it, but they fail to do so. And in the meantime, all of the reviews, I think I had 6 reviews last week, and the vast majority of the reviews were clients reaching out and wanting to have a review of their assets based on their volatility for the last couple of weeks and the last in this second quarter of 2019. Now, something interesting that I've said before is that Warren Buffett said many years ago that there are 2 major rules of investing your money. Rule number 1, do not lose the principal of your investment, meaning that whatever money you set aside for investments, the principal that you set aside, rule number 1 would be not to lose that. And then rule number 2 was not to ever forget rule number 1. So I think he was very critical in understanding that being able to always guarantee your principal or invest your principal in a way that your susceptibility for losses were not going to be related to the outcome, 5, 10, 15, 20, 30 years down the line was very critical for him. And it is one of the major principles that he uses in his own personal investments. So with that being said, shouldn't you protect your principal at all times? I mean, if Warren Buffett emphasizes the fact that you need to protect your principal, why would you want to argue with one of the greatest investors and money managers in the history of the world? I would argue that at worst, zero should be your new hero. And I'll explain a little bit more about that. But, I think Americans need to seek growth while protecting their principal at all times, because what has happened in the last few weeks is seldom announced, and very few times do the forecasters get it right to begin with. So that's something that's very, very important. The other thing is that here's why protecting your investment principal is so critically important in today's economic environment. See, if you have a loss of 25% in the market, it requires a 33% return in 1 year just for you to break even. So you're always chasing that and getting back to zero market fallacy, because if you have a loss of 25% on any given year, the following year it would take a 33% bounce back in order for you to get back to where you were at previously. And obviously, you're not going to be able to recover inflation losses, from the previous year unless you have such an incredible return on the following year to offset all of that. Let's make it a little bit more interesting. If you suffer a 33% loss in the market, it does require a 52% return in 1 year to break even. And if you suffer a 50% loss in the market, it requires a 100% return in 1 year in order to break even. Now, how many times have you seen the market go up by 100% on any given year? So that means that if you have a 25, a 33, or a 50% loss on any year, it's going to take a number of years for you to get back to zero. And in the meantime, the inflationary forces are applying pressure on your assets every single year, so you're never going to be able to recover from those kinds of losses from an inflation, from a rate of return, and also from a tax planning perspective. So the big question is, well, doesn't it seem absurd that many of us are still investing in the stock market without a safety net? One of the webinars that I cover, one of the presentations that I cover with many attendees to our colleges and universities seminar workshops is one that deals with jumping out of an airplane without a parachute. And this is what Americans are doing every single day because they don't have a parachute to tie onto their principal in order to mitigate any stock market volatility in the future. And when it comes to retirement, those issues are going to be accelerated to a point of no return. So the other way is that, think of it this way. If you're gambling your hard-earned dollars in the stock market, then you should be able to at least expect the following. Number one, you should be earning a return equal to and or in excess of the traditional annual inflation rate on a compounded basis. So if you're going to be risking 100% of your money in the stock market, the least that you could be expecting is a return every year that would be equal to the inflation rate for that given year. So at least you're staying up with inflation and you are not losing value and purchasing power because you're not keeping up with inflation. Most important, that inflation rate, which is not something that gets reported often enough, that inflation rate or the CPI rate should include the increase in prices for food, energy, and healthcare. So if you're going to add all of those areas to the CPI, then you should be expecting at least a 4% CPI return on any investment that you make. Number two, since you're risking your principal with no downside protection unless you have some kind of a principal protection plan, then you should require, I would argue, an additional 400 basis points and or 4% for the added risk and you're taking into consideration because of the fact that you're investing in the stock market with no principal protection and or parachute. So therefore, you should be shooting every single year for a consistent 8% return in order to stay ahead of inflation and or stock market volatility. I mean, if you're not able to get those kinds of returns, then why would you want to expose your hard-earned dollars and your assets to volatility that may be detrimental or will be detrimental to you and to your family, not only now but also in the future? So obviously, based on all the things that we have discussed up until now, I would argue that based on above-mentioned premises, the Dow Jones Industrial Average has not kept up with inflation and or volatility risk return, and the vast majority of Americans have not recovered from the dot-com market crash at the turn of the century. So I'm going back that far. I'm going back 18 years. And for many of the people that I have audited and that have come to me that were not clients of mine at that point in time, but then again came to me after learning more and more about principal protection, whenever I have done those audits, sadly enough, those clients have not been able to recover from the dot-com failures that we had at the very beginning of this century. Now, the question is, well, where should the Dow Jones Industrial Average be today in order to have kept up with the inflation and the market risk that we've talked about? And here's a simple math that I try to share with each and every one of my clients, because if I'm able to do that, and I'm going to be sharing this with you, then hopefully you're going to be able to open your eyes to the opportunities and the fact that if you're able to protect your principal, then you have done an extremely well done job in order to minimize any volatility in the future. So let's go back to the year 2000, and that was obviously 18 years ago, because we're in the 19th year, but the year is not over yet. So the Dow Jones Industrial Average closed for the year on December 29th, 2000. And that Friday, the Dow Jones average closed at 10,788 points. So that was actually very good at that point in time. Now, based on our premise of an 8% annual return, which would include principal risk and inflation risk, the Dow should have closed at 43,109 points on Monday, December 31st, 2018. Now, do you see the craziness of this? Obviously, the market was not even close. But if we're going to apply the premises of keeping up with inflation and also getting a rate of return on that stock market volatility risk that we're willing to take in order to grow our retirement assets, then we should be expecting an 8% return. So therefore, you should have been at 43,109 points by December 31st of 2018. Now, let's say that you say, well, Bert, maybe 8% may be a little bit too aggressive. Although many advisors out in the marketplace are claiming that you can get a 12% average in the market or consistently on a regular basis, which is totally ridiculous to even consider. But how about a 6% return as opposed to an 8% for the same exercise that we just went through? Well, the Dow then should have closed at 30,793 points on Monday, December 31st, 2018. So we weren't even close. So therefore, we were not definitely close at the 8% rate of return and not even close at the 6% rate of return. So I think the question that most of us should be asking ourselves, and that all of you should be asking yourselves, would be, well, what has the Dow Jones Industrial Average done over the past 18 years? Well, the Dow has done a whopping 4.31% over the past 18 years. Not even enough to keep up with the real CPI rate if you're going to factor in food, energy, gas prices, and healthcare prices, and so forth. And by the way, these numbers include the longest bull market in American history. So the big question that all of you need to ask yourselves is, well, are we closer to a market crash today than we were a few years ago? What do you think? Obviously, this is a conversation that you need to have with yourself. This is a conversation that you need to have with your advisors. And this is something that you need to ponder on because at the end of the day, protecting your retirement assets is the most critical aspect of a successful retirement plan. So I think the other question that I would ask all of you is, well, isn't it time to get off this roller coaster? Because it keeps going up and down and up and down, and then when you average everything, you're barely doing 4.3% return, and you're barely keeping up with inflation. And the reason why it is time to get off this madness is for a number of different reasons. Number one, you have no control of inflation, taxation, world economic trends, major catastrophic events, terrorism, global and or U.S. national debt management and control. Now the national debt is well north of $22 trillion and counting, and we have no control over that. Presidential impeachments, tariffs, negotiated trade deals. Yet most of you and most of us are exposing our retirement dollars to volatility above and beyond your comprehension and our comprehension from an economic standpoint. I think the another question that I would ask all of you is, how many market crashes can you afford in retirement? While you're taking money out of your retirement assets as they lose value in order to maintain your standard of living. See, most of us are now getting ready for retirement. We've been in an accumulation stage for many, many years. So even if you have experienced stock market volatility, these were primarily paper losses because of the fact that, you were still employed, you were still making money. You didn't need to invade principal of it or interest from your retirement assets because you didn't need those assets in order to maintain your standard of living. You were still making contributions to your IRAs and your 401ks. Your employer was probably still giving you a match every single year on your contributions. So if you actually looked at your statements, as it happened in 2000, 2001, 2002, 2007, 2008, 2009, and you saw those losses piling up, at least you were able to wait it out. But once you get to retirement, the rules of engagement totally change, because now you're going from accumulation to distribution, and you will have no choice but to start invading principal and interest on assets that are dropping in value every single day. But you still need to invade, and now you need to start liquidating those soldiers that you had set aside in order to protect your retirement assets, and you then would be highly susceptible to pretty much running out of money before you run out of life. So those are things that are very important to consider from a business perspective. So what are some of the options that you have? Well, obviously, you all have the ability to reach out to me if you want to review your investment risk and or how to diminish your investment liability while seeking more financial freedom with a lot less risk and volatility from a business perspective. There are a number of vehicles that are available in the marketplace in which you can invest your hard-earned retirement dollars and guarantee yourself that those dollars, the principal of those dollars, are always going to be protected. And most important, you can still participate in the growth of the economy of the United States, in the growth of the market, without having to participate in the losses of the market along those lines. So I think it's very critical for those of you that are listening to me today that you really assess your situation. because the definition of insanity is pretty much doing the same thing over and over again while expecting a different result. Now, we suffered a market loss in 2018 for the first time in almost 9 years. This year, there's a lot of volatility. Who knows what's going to happen? But obviously, it doesn't look very pretty. None of us can determine when there's going to be the next market crash. All I can tell you is that there's going to be another one. And also remember that, if you go into retirement in the first 2 to 3 years of retirement, you suffer market losses, those market losses are going to have a major impact, and you may actually run out of money before running out of life anywhere between 7 and 13 years sooner than expected, sometimes even 15 years sooner than expected, because of the fact that you needed to invade your principal or the principal of your investments at a point in time when those investments were also going south because they were losing value every single time. There are also some techniques that we use for many of our clients that may be suitable to some of you. One of them, we call it a volatility buffer, in which we set up different accounts where you have guarantees. So if you still have a percentage of your investments in a stock market portfolio, and that portfolio were to lose value at any given point in time, that you also have other assets that are guaranteed that you can dip into and take money out and not take it from those assets that lost value in a given year. And depending on the amount of assets that you have in the volatility buffer, then you can buy yourself a few years, sometimes 2, 3, 4, or 5 years, in order to allow those assets that you lose money on to kind of recover based on market conditions. So for those of you that want to reach out to me, please feel free to do so. You can call me at area code 766-1042. You can also email me at Bert, B-E-R-T, at gablestaxgroup.com. And I want to leave you with the thought that I leave you every single week, is that my number one goal and that of my firm is to help all of you change the way that you see things. Because when you change the way that you see things, the things that you see change. So again, thanks very much for giving me a few minutes of your time today. And I look forward to seeing you again next week and talking to you and bringing you another excellent podcast for all of you. And please do not forget to sign up for our podcast so you can get it on a weekly basis on a automatic download. So I'll talk to you again next week. Take care. Bye-bye.